we're projecting the future. We can't control these things, and we can't necessarily anticipate all the scenarios. But if things go bad, it could be as bad as just all kinds of supply side data, absorption trends. It's one of the best sources of supply side data in the market. New construction trends. You can start to forecast when do we need to start adding new supply to the market. Performance with asking rent, percent vacant inventory. Like, I'm using these every time I'm analyzing a market. Rent distributions. This is just great data when you're analyzing a market. I think you should redo the lighting in here so that my hair looks less gray. Because when I see myself on the videos, I think my hair looks more gray than it actually is. Is there something you can do about that?
I hate to break it to you.
You know, Dad called me this morning.
Yeah.
And he's driving over to meet with Cody in Evansville, and he listened to Monday's podcast. It was the one where you were interviewing me about the tiers of investing.
Yes.
You know, we talked through that.
Yeah.
He thought it was one of our best episodes.
Hey.
And he went on quite a long time about how good of an interviewer you are.
He keeps saying that recently.
And I agree with him. Like, you do a great job asking insightful questions and pulling things out of me. It makes it a lot easier for me.
Oh, yeah.
I just wanted to pass that along.
Oh, that's nice.
He also said he really liked it because that episode was a little bit more serious.
Yeah.
You know? It's like, well, I'll let Timmy know that he should be more serious.
Yeah.
So anyway, I wanted to do a shout out as we start here.
Okay.
For a student of mine in Austin, Texas, about a month ago. His name's Andrew C. And he lives there, but he was a former Marine like me.
Yeah.
And on the last day of class, he brought me this.
Yeah, some little rocks. A little bit of sand.
It's volcanic sand from Iwo Jima.
Oh, cool.
Iwo Jima is where that iconic photo of those Marines raising the flag.
Oh,
like
yes, that's right.
That was Iwo Jima. And so when he was there in 2009, he scooped up some sand. And so on the last day of class, he brought me this little jar of Iwo Jima sand.
That's amazing.
It was an unbelievable gift. Like, I almost teared up. Like, to a Marine, like, something like this is just super cool. And so, Andrew, I really appreciate this, and meant to give you a shout out before now, but I'd forgotten. I'd actually brought it in here, and it's been sitting.
And we'll continue to do so.
Yeah.
Yeah,
that makes the cut.
That's awesome.
That was a really cool thing. So thank you very much. I appreciate it.
Yeah, that's so great. Saving Private Ryan, what's that battle that it opens up on?
That was on, I think, Omaha Beach.
Omaha Beach, yeah.
In France. Yeah.
And didn't Granddad Rogers, wasn't he a part of Omaha Beach?
He was.
Yeah.
Mm-hmm.
That's just so cool.
Matter of fact, Mom tells a story about when they were watching that movie that he got pretty emotional because it was so realistic.
That's right.
To his recollection of what it was really like.
I remember that. Yeah, I remember.
Can you imagine, like, living something that horrific, and then a movie is made about it, and they capture it so well that it takes you, I mean, like, you probably didn't really want to relive that. But for the rest of us who, you know, didn't have that experience to be able to watch that movie and get a sense of what those men actually went through, and the unbelievable bravery, and it's incredible, really something.
Come on, Spielberg. Yeah, I remember, because up until that time, like, the war movies I just remember it didn't capture it like Saving Private Ryan did, the experience, the realism of it. And I remember that Granddad saying that to Mom. And
you know what? I forgot one other thing.
What?
And I mentioned this on the last episode, but we got TreppWire T-shirts.
Do you have them?
I do.
Yeah. Oh, yeah, baby. Yes. Oh, blue.
So,
this is great.
You can edit this part out. But
oh, no, I'll keep this
me shirtless.
Look at this. Talk about shout-outs.
Thank you, TreppWire, for the T-shirts, and we are honored to promote your very, very awesome podcast.
Yes, we love y'all.
And if you're a listener of Commercially Speaking, and if you're listening or watching this, then obviously you are. We would highly recommend you check out the TreppWire podcast.
Yeah.
What they do over there is so beneficial to anybody who's a CRE professional.
Yes.
And,
which is
those
what?
guys are friends.
Which is what? Yeah.
They do like a week in review.
That's right.
And so, Trepp has all the CMBS data. They have all this banking data. They track so much stuff. The insights that they can pull from that data are really second to none. And so what they do every week is they go through what's happened. And so they'll start at kind of a macroeconomic level. They'll talk about interest rates and a lot of other things that are happening at a macroeconomic scale. And then they break it down into, they'll go through some multifamily transactions, some office transactions, whatever's happened that week.
Yeah.
And, bring that macro level down to what's happening. Okay, what did these transactions tell us about what's going on in the industry in those different property types and different markets? And and it's so good.
Yeah, where we are a commercial real estate investing podcast. We're like commercial real estate and entertainment, right? They're like commercial real estate, what's happening right now, treasure trove of data.
Yeah. It's so good. So
yeah,
I listen to them every week, and they do a fantastic job. So those are our friends, Lonnie Hendry and Haley Keene and Stephen Bushbaum, and I got to meet them in their office a couple weeks ago in New York City, which I talked about on a previous episode. But it was just really cool, and they had these T-shirts.
I'm happy to wear it.
Yeah,
I'm happy to wear it. Yeah, I miss you, Lonnie.
Well, we'll have Lonnie back.
We've had him a couple times. Yeah. Okay. Well, welcome to Commercially Speaking. I'm Timmy Barron, ADHD.
And I'm Bo Barron, CCIM.
And every week, Bo teaches me everything he knows about commercial real estate. Started an idiot, and now I'm here to not so much as one.
Yeah,
in commercial real estate. Yeah.
That was another thing Dad said this morning was, man, it's just amazing to me how much Timmy knows now.
Right.
Yeah. And he was saying that in the context of you're asking even more insightful questions and stuff, demonstrating your understanding of a lot of these concepts. But
yeah, because it's interesting because it took a while to get a baseline. Because if you just look back at some of those first episodes, they're great as far as the content and what you're teaching. But I'm like, stop, wait, what? And who was our first guest? Was it Lonnie? If I remember correctly, one of our first guests.
He was one of our first guests.
Yeah, one of the first ones. And I remember even with that guest, you had to stop him several times as well.
Yeah, he kept using terms. I was like, hey, you're gonna have to explain to Timmy what that means.
Yeah.
Some of the terms that Lonnie uses, I don't understand either, and so I was using you as a surrogate. You're happy to do it. Explain to Timmy and me what that means. Yeah.
Happy to do it. All right. Well, what are you teaching me today?
Well, last episode, I demonstrated some site to do business stuff and showed you how you can get demand data. So let's just kind of review the idea of the demand side of the equation. Like, what drives demand for commercial real estate?
Okay. People. Would before people watch this, would it be good to watch that one?
Yeah. Well, these two episodes in tandem, whether you watch this one or the last one first, they're really going to fit together well.
Yes.
I don't know that it's so important that you watch the other one first.
Okay, cool.
You don't have to stop this one and watch that one so that you understand this one, but this is the other side of the coin.
Yeah, and before we dive into it, I'm sorry, Bo, but before we dive into it, next week we are doing a market analysis from the winner of our drawing. And so these two, this one that you're watching now and the one we put out last week, those two would be great to watch before we jump into the market analysis.
Yeah, they lay a lot of the foundation of what we'll be doing when we actually go through the market analysis. That's exactly right. Yeah.
Cool. All right. So,
by the way, since you brought that up, I got a text message yesterday from our friend Scott Overby, friend of the show. We've had him on. He's in Mississippi. And he goes, I want to, he puts in a Mississippi market to the hat. I was like, dude, we just drew earlier in the day, or yesterday. And I told him, what market won, the one in Florida. And he was like, dang it, Florida gets everything. I was like, I'm sorry, man.
We'll throw it in. Well, I've got a feeling we'll do it in the future.
So what?
So,
back to demand, just to sort of set up the other side of the coin.
Yeah.
People drive demand for space.
mm-hmm.
And one of the things you're doing when you're analyzing a market, analyzing any kind of property, helping someone with site selection or all these other things, is you're trying to quantify demand. And Site to Do Business, and specifically the business analyst function that's built on the Esri data,
Mm-hmm.
Allows you to do that. And, we looked at the mapping software and
Mm-hmm.
how to put, by the way, what are demographics again?
Demographics are different. And so, well, it's really hard for me to put into words. It's a demographics are like the different categories within who people are.
Yeah, so give me an example.
So, gender would be a demographic. Income would be
Mhm.
a demographic. Age group would be a demographic. Household size, would be a demographic. Like, all those
so
little.
all the things that are factually true about the people in a geography. So it's the quantifiable truths
Mm-hmm.
of who the people are.
Right.
It's the quantitative facts about them.
Yes.
Okay.
Yeah.
What's their average age, average household income? We talked about mean and median and
Mm-hmm.
all those different things, and we showed how you could put some of that on a map and really do some cool stuff.
Yeah.
Right.
Really cool stuff.
So it's just totally a great tool, but it's almost completely on the demand side. What Site to Do Business can give you in that business analyst function. But that's only part of the equation. The other side of the equation is to quantify the supply side of a particular geography. And that proves to be much more difficult. And Site to Do Business is not the tool for that. I mean, you can get a little bit of supply side information, but not a whole lot.
Yeah.
So today, what I wanted to do is demonstrate a different tool that provides a lot of that supply side data. You just told me, like on the demand side, we're looking at demographics, and we also talked about psychographics and what that actually means on the demand side. But on the supply side, we're not talking about people. What are we talking about?
There's space.
We're talking about the space.
Right.
So what are some metrics that would be important to understand about the space in a market?
Well, the different types of space,
Okay.
right? Like office, manufacturing,
Yes.
or industrial. And the size
Yep.
of the
Size.
space,
Yep.
the vacancy,
Yep.
the location.
Yep. All that stuff is supply side data.
Mm-hmm.
Average rents, effective rents, vacancy, occupancy, long-term average occupancy. We've talked about that in conjunction with absorption in our absorption episode. Absorption is actually a demand side metric, but on the supply side, like how you describe and categorize and delineate the space in a market. And that's very difficult to do. None of the big data companies that you can get some supply side data from, and I'm going to demonstrate one of them today.
Okay.
They don't cover Owensboro. They don't cover the smaller markets. They've got really good data on the larger markets and even mid-sized markets, even some of the tertiary markets that are generally bigger than Owensboro. But in Owensboro or in these smaller markets, like if you want supply side data and you're a commercial real estate professional like we are, in a smaller market, you've got to go get it yourself. So you're talking about doing rent surveys, talking to the owners, building your own data set.
Yeah.
You might be using like here we would use the PVA site,
Okay.
Property Value Administrator site. Those are called different things in different states. But to get that supply side data, you have to go get yourself. And I will also mention, you remember when we did the episode on how do you answer the question, how's the market?
Yes.
And we played a clip of Bob Knackle on the TreppWire podcast.
Right.
Of him answering that question with data.
Yes.
Most of the data that he used is supply side data.
Right. Right.
He was talking about occupancy and vacancy and transactional velocity and the amount of space. I forget what the number was, but he described, the 26,714 commercial buildings south of 96th Street. Like, That's supply side data.
Right.
It's talking about the space. And he's so good at that because he does not just rely on a tool like I'm going to show you today. He and his team goes and gets that data himself.
Mm-hmm.
And that's why they're such experts. And so even though I'm going to show you a tool that can give you a lot of this data, the best case scenario is that you and potentially your team can go out and get it yourself. That makes you the absolute expert in your market.
Yeah.
So I would highly recommend you try to do that. Okay.
Yes.
But this tool right here, like when I'm analyzing a market we might want to go into or invest in with the fund or whatever, this is one of the tools that I use to quickly understand the supply side of the market. And it's called Moody's.
Moody's. Okay.
Moody's Analytics. And we probably need to log in.
Yeah, hop on in here. While Bo's logging in, y'all should check out that Stop Using Adjectives episode of how to answer the question, how's the market? And you can watch that right here.
Okay. Can you see my screen? Moody's.
I see it.
There's a whole lot I could take you through in Moody's, but what I want to do is I want to demonstrate REIS reports and some of the historical data.
Okay.
So just like on the demand side, the first thing you have to do is you have to define your geography. When we were working with Site to Do Business, we had to define our geography. And what were the two different types of two categories of geographies?
Yes, you had formal and functional.
Formal and functional. Formal being
what the man has established.
Yep, they say.
They say.
And functional is
we say.
We say. You, the analyst, decides. You make the call.
I'm creating my own boundary here.
Yeah, and you can use a polygon or a drive time or a radius or some of those other tools. Yeah, the Rorschach test. So here, you would do the same thing, except with Moody's, you're generally going to be choosing markets. And they have a lot of markets and submarkets already defined for you.
Okay.
All right. And so...
But this is still under geography.
Yes.
Yeah, okay.
So the first thing I'm going to do is if you go to search and then search all properties here, it'll take you to the map. And... Look, we're in Louisville right here. I think that was the last thing I was looking for. But let's just scroll out, and you can see all those little dots are commercial properties.
Oh, wow.
Red is office. Yellow is multifamily.
That's a lot.
Green is retail. But what was the market we used
Boulder.
last episode?
Boulder,
let's
Colorado.
Let's just go back to Boulder.
Great.
Boulder, Colorado. All right, and there it is. And you can see just that mass of dots for commercial property. So what you can see is like Moody's has some great, and by the way, I should say, Moody's has a lot of different levels of products, right? So traditionally, we have used Catalyst.
Okay.
Catalyst used to be a separate company. Moody's bought them. And it's a site where we have our listings on there. It also has all commercial properties on there. And they've, like here, it says there's 2,002 commercial properties in this Boulder market. Okay. That may not be all of them, but it's probably all of them or really close.
Okay.
Okay. So it's got all the properties. It's also got listings that are on there. And so for any one of these, if we zoom in and we go to downtown, what I perceive to be downtown, which is probably where all these office products are here. Let's just, you can see that's downtown. So let's take this office building right here. Let's see if I can get something that's, all right, that looks kind of cool. So that's this office right here. I clicked on it, and I can get some property level details. It's 98,451 square feet on just under an acre. It's 81% occupied. It's a multi-tenant building, Class A. Looks like it's got 3 stories. It was built into, just basic information. If I click on view details, it will give me more. Like I can get more photos if I click on here. And these are nice, high-quality photos.
Nice building.
Pearl West. And I can go down here and, okay, it's in Boulder County. It's that parcel number. Here's the REIS market and submarket. So it's the Boulder market and the CBD submarket. Now, CBD is not what you think. when you think of CBD.
Central Business District.
Central Business District. Yeah. That's right. Building size, building details. It's masonry. It's not on water frontage, land, taxes. Tax amount was $1.8 million. Year-over-year change was 7.6% on the taxes. The assessed value is $18 million, etc. You can also go to the contacts. So active listing agents. If I wanted to call these guys, looks like Cushman Wakefield from Fort Collins and Denver have this. The legal owners are 1011 Pearl LLC. The true owner is Invesco Real Estate. All right, so this is like the LLC that owns it. And when you go down a layer and you see who owns that LLC, you'll find it's Invesco Real Estate. So if I wanted to reach out to the owners, I would call these folks at Invesco Real Estate. And here's their president, chief executive officer. It gives that information.
Oh, wow,
this
nice.
is great information.
Right.
Okay.
Which you wouldn't particularly get on Zillow.
Correct.
Right? You get the either Tyler Bray or James Arnold, maybe.
Yep.
Shout out to Tyler Bray and James Arnold.
Yeah. So we can also look up the tenants. So here's the tenants in the building.
Oh, wow.
All right. 10 is most recently verified. All right. So you can see Ramen Brand Store, Hapa Sushi Grill and Sake Bar. I don't know what.
Hapa Sushi.
Like, how would you pronounce that?
Well, it looks like it's in another language, whether it's Swedish.
The parking garage and Harrison LLP, which sound attorney's office, that they haven't been verified as recently, but with all the green over here, I feel pretty good that this is some pretty accurate information on the tenants that are in this building. Yeah. You can look at the history, go to the listing information so I can contact the agent here, view the flyer, view details, etc. Okay.
And, I mean, this is probably obvious, but the reason to know who the tenants in this building are is so you could possibly reach out to them and be like, hey, how's the building?
Not necessarily. If I was considering reaching out to these folks because I wanted to buy the building, it'd be key to understand who the tenants are. Okay.
Oh, right.
Or if I rep a different building, I might see who the tenants are here and contact them about potentially relocating. There's a lot of reasons why that data could be there.
Maybe you're working with the business and seeing if they would fit in this building with other tenants.
We also have performance here, and so now we can see there's asking rent of $19.64 per square foot. Here's kind of the asking rent change over time. So this is Q2 2020. You can see there it pops up CBD rent, CBD vacancy. So that's talking about the submarket that it's in.
Okay.
Boulder rent, Boulder vacancy. And you can compare that. Some other information. And then down here, there's this little tab called reports. And this is what I'm trying to get to. In Market Pro, which is what this is, or if you use Catalyst for Moody's, all of what I've just showed you is basically the same on either one of those products. When you click on reports, you can create general reports, Google Earth, Excel. But this REIS used to be a separate company, and what they did was they tracked supply-side data in markets. They're the ones that have researched all. Yeah, Esri's such a monster company. I don't think you could compare REIS to it. But in some ways, what Esri does for demographics and the demand side data, REIS and their army of researchers and economists did on the supply side.
Yeah, okay.
And those REIS reports, it was expensive to subscribe for REIS. Like, they have to do a lot of work to collect this data, and their information in their reports was very valuable. It was an expensive proposition. Well, Moody's bought REIS. And so now the REIS reports are part of the Moody's products, at least the two products that I'm familiar with in Catalyst and Market Pro. Mm-hmm. So just a short commercial for Moody's Market Pro.
Yes.
I just signed up for this yesterday.
Oh.
I've used Catalyst for a while, so I've had access to the REIS reports. But I signed up for Market Pro over the last couple of days. I think I got access yesterday. And the reason I did is because I can go get some historical data. that I couldn't on the Catalyst
Oh,
platform.
gotcha.
And I'll show you that here in a minute. It's pretty great stuff.
Okay.
But this report, this REIS report that I'm going to show you here,
Anybody could get in.
anybody can get into this. Now, if you're a CCIM candidate,
Mm-hmm.
you can get Market Pro for just about half off. It
Oh,
ends
okay.
up being like $125 a month. So you can access these reports. Oop, there was an error loading the reports for this property. So let's try this again. I've seen that happen sometimes. And a lot of times if you just reload and go back. Nope.
The reason I asked that, because Site to Do Business is
Part
you've
of
got
the-
part of the membership, but this would be half off. It's not particularly under the CCIM umbrella.
It's not.
As
So
it were.
Moody's is, but we've got to deal with them, and you get it for about half off. So for the entire country that they have coverage for.
Mhm.
So again, you're not going to get a REIS report on Owensboro, Kentucky,
Mm-hmm.
but I think I can get one for Bowling Green and Louisville. You know, these bigger markets. You know, Boulder's not as big as Louisville, but it has coverage.
Oh, gotcha. So the reason it's so hard for the supply side is kind of specific to the size of your
It's-
market or the market. You're
Does
looking at.
REIS and Moody's cover it? Do their
Right.
researchers, do they cover it? And they cover the larger markets. And,
Yeah.
you know, at some point they run out of bandwidth and the smaller markets get cut.
Sure.
So Owensboro's never quite been big enough. And maybe over time they'll be able to add the smaller markets. I have no idea.
Okay.
But in some ways there's a little bit of an advantage if you're a commercial real estate professional in a smaller market.
You're the one with the information.
I'm the guy. Like in Owensboro, if you want this kind of information, like you almost kind of have to talk to me
Right.
or somebody like me.
Yeah.
Like we hold that information, and that makes our position in this market, if we actually do have the information and we're experts, that gives us a real competitive advantage.
That's right.
But as an investor, if I'm looking at Boulder, I can come in here and I can run a REIS report,
Okay.
and I can get it for the market or the submarket. All right. So I'm going to click on the submarket report, and this is going to be CBD Office.
Okay.
And let's just see what CBD Office looks like in Boulder, Colorado.
All right. If we're talking about another CBD, it'd probably be pretty big in Colorado.
Mm-hmm.
That market.
Yeah, you're right. So this is the report. It's 31 pages, and man, the information in here is incredible. Right. So first thing it does is it shows you, all right, this is how they delineate, how they draw the CBD submarket.
Okay.
Right? So that's it. There's no question about what it's looking at. It gives you the map.
Okay.
And then it gives you the table of contents. So key performance indicators, asking rent, submarket performance, submarket inventory, all this information. This is almost exclusively supply side information. Now, this is what I want to start with. Let's just look. CBD, their vacancy rate's 21.5%. All right. Now, that's up from, I think that might mean 21.0
I would assume that
from
too.
Q4 2023.
Okay.
Looks like they just missed a
Missed a decimal.
decimal point.
I always do that. I always miss the mundane details. It's not a mundane detail, Michael. It's from
The
Office Space.
Office. Oh,
Yeah.
yes.
It's like I always do that. I miss a mundane detail.
Yep. That movie is all coming back to me now.
Yeah. What
So,
a great movie.
In-
Michael
income
Bolton?
growth per household is up.
Down
No,
0.1%.
it's down versus,
Oh, it's down.
it's less than. So income growth per household is 1.3% as compared to 1.4% national.
national. Okay.
All right. And job growth is 0.6% versus 0.3% national. So just
Thank you, Joe
some,
Biden.
Some KPIs, right?
Yeah.
Asking rents and vacancy trends. Okay. So CBD asking rent is this light blue bar. And, you know, it's at, you know, what, above 24%.
Mm-hmm.
Boulder asking rent is for office is quite a bit lower. So you're going to pay more if you're in the CBD. That's normally pretty normal,
Mhm.
right? CBD vacancy is this line down here. And so you can see what it's done going back to 2008. It's really dropped down. 2012, 2014, the vacancy percent was very low.
Wow.
And then it started to come up, and then it has continued to go up until we're at, 21.5%. All right. As opposed to overall Boulder, their vacancy rent has been higher than CBD. And then now it almost looks like it's just a tick lower.
Right. Wow.
And we've seen that. That's kind of a result of COVID. CBD, where all the office people,
Yeah.
a lot of them work from home, or now they have hybrid. And so hybrid work. So the demand for office space is much lower than it was.
I see.
And so the fact that vacancy in the CBD for office is up just about across the board nationally.
Oh, gotcha.
Makes a lot of
I see.
sense. There's just not the demand that there used to be.
Gotcha. There's more vacancy.
Yep.
Yeah. I was looking at it, or I was thinking about it the opposite. No. Okay.
Yep. And so for Boulder, and it looks like they don't have asking rent and vacancy rent projections, but for the Boulder market, asking rent they think is going to be going up a little bit, and vacancy rate will be going down a little bit overall. But they don't have the data for the CBD.
Okay.
Now, if we were in LA or Chicago, they would have that information. But this being a smaller market, they don't have it for the CBD for whatever reason. Then if you go for the submarket performance, now notice over here, they're doing this by quarters, Q1, Q2, Q3, Q4, and then the year. So these first 5 are all 2021 numbers. Asking rent, 28, and you can see what it did, and the asking rent change.
Okay.
Percent vacant. So vacancies have been going up. Asking rent has been going up and down. So for Q1 2024, asking rent is $30
Whoa.
right,
Look
per
at
square foot.
the year 2023. Well, I guess that's the year, so the number is going to be bigger. But even compared to the year of 2022, 4.8%. That's a big
It's a big jump.
2023 year.
In 2022, for the year you had asking rent change actually went down 1.1%.
That's right.
So you can really get a feel for change and trends with this supply side data. So if I'm looking to make an investment in office in Boulder, this gives me some great supply side data. All right, how much vacancy, what are rents doing, et cetera. Now, submarket inventory. So now we're not talking about rent, we're talking about inventory. How many square feet are in the market? Well, 1,476,000 square feet. And what do you notice from 2021 to 2024 about the inventory in Boulder, in the CBD?
No change.
There's been no new construction. So over the last 3 years, when you looked at the pipeline to see what kind of completions, what kind of new supply were going to be added to the market,
Right.
There was zero. So there's been no new office construction in CBD Boulder
Right.
for the last 3 years.
Makes sense.
Okay.
Makes sense.
Vacant stock in square feet. This means how much vacancy. So 206,000 square feet of vacancy of the 1.476 million square feet total.
1,476,000. Yeah.
Occupied would have been the remainder, and net absorption. Remind me what absorption is.
It's from it's how much vacant space has been filled.
Yes. How much more occupied space has there been over the last year? And so what this is telling us, for the year 2021, 23,000 square feet in the CBD became occupied, net.
Yes.
Okay. And then as you go through, you can just see. So on average, 23,000 in 2021, 2022, there was 19,000 of absorption. 2023, 42,000 square feet of absorption. And
Oh, wow.
actually, this is negative absorption.
Yeah, that's negative.
Yep. So 23,000 square feet became vacant. In 2021, 19,000 became vacant net
Yes.
over the course of that year. And then 2023, 42,000. So there's a net out migration.
Right.
and you can see this in the vacant stock numbers. Occupancy numbers are going down. Vacancy numbers are going up over the last 3 years.
Yep.
And it's been a fairly consistent amount.
Right.
Okay. And then another 30,000 in Q1 2024 has become vacant. So I would say CBD office space in Boulder, Colorado is trending down. It's not doing great.
Right.
Right. Or over the last 3 years. And so this is just full of information like this. Now, I want to go to a different market that is going to give us a little bit more data and show you an example. And let's use Louisville, Kentucky, just because I'm a little bit more familiar with it. We'll go back down to the CBD here, look at office, and I can change this and say, hey, I just want office. And so now it's just the office properties. Let's grab this one right here. I've actually been in this one. That's not a good picture. That's the Baird building downtown, 500 West Jefferson. Okay. Now let's pull the report on this. So again, I have to go to
Looks
view
like
details.
a deck of cards. It did.
Performance, reports, REIS. And let's grab the CBD submarket for Louisville, Kentucky for office and see what that report looks like.
Bicycle, you should make a deck of cards look like a building for all of our commercial real estate professionals that like to play cards. Yeah, it's a good idea.
That's a good idea.
You can have that for free.
So what this report has that the Boulder report doesn't have is a narrative to start this report. So again, there's your map, here's your table of contents, and then here's the narrative. This executive briefing didn't exist on the Boulder report, and my guess is that's because Boulder's just a much smaller market.
Yeah.
So they didn't do the executive briefing, or maybe they didn't have this. But when you read this narrative, this sounds like Bob Knackle answering that question, except Bob does a better job. Okay. So submarket overview. All right. So just listen to this.
Okay.
With 8.4 million square feet amounting to 36.9% of the total metro inventory. And again, we're just talking about office. The Central Business District submarket is the largest of the 6 distinct geographic concentrations that form the Louisville office market. In the 10-year period beginning with Q2 2014, new additions to the submarket totaled 90,000 square feet. Or in other words, 90,000 square feet of new office product has been built over the last 10 years. So not a lot, okay? While 420,000 square feet were removed by developer activity. All right, so they demolished 420,000 square feet of obsolete product.
Okay.
The net total loss of 330,000 square feet equates to an annualized inventory growth rate of negative 0.4%. By contrast, the annualized growth rate for the metro over the same period was 0.4%. So Louisville overall has added annually 0.4% new supply for office. But the CBD area downtown has had negative 0.4% growth or loss. All right.
Okay.
Monthly movement in asking rent during the first quarter was varied, with rents remaining flat during March, leaving the cumulative quarterly total gain at 0.9%. Right. So asking rent has gone up by 0.9%. Over the past 12 months, asking rents have climbed a total of 0.7%, up from $18.09. The Central Business District submarket's March asking rent levels are higher than the Metro's average of 18.10%, while asking rent growth in March compares unfavorably to the Metro average of 0.1%. Effective rents, which exclude the value of concessions offered to prospective tenants, rose by 0.3% during March to an average of $14.76. So, in other words, asking rents, $18.09. Right? Effective rents are $14.76. They're taking out, or they're factoring in concessions. Now, have we ever talked about concessions? Concessions are things like free rent, period of maybe 6 months free rent.
Okay.
Or other types of concessions that a landlord can offer to incentivize a tenant to lease their space.
Gotcha.
When you factor that in, it's almost, a little over $3.25 a square foot in concessions.
Okay.
Right? competitive inventory, employment, and absorption. Total employment in the Louisville metropolitan area grew by 700 jobs during the first quarter, while in the dominant office-using industries, employment remained essentially flat. So employment in Louisville during the first quarter added 700 jobs. Mm-hmm. And what it's saying is almost none of those jobs are office-using jobs. All right, so it might have been industrial, retail, other types of jobs. Okay. Absorption rates of competitive office space may not immediately reflect quarterly total job gains or losses, but it's prudent to consider long-term economic and demographic performance as influential upon current occupancy levels. Since the beginning of Q2 2014, so over the last 10 years, the average growth rate for office-using employment in Louisville has been 0.6% per year, representing an average annual addition of 1,200 jobs. All right, that, without reading all of this, equates to 14,300 square feet of annual absorption on average. Mm-hmm. So, and you can just continue to read all this. This is all, and it's, not that interesting to just read it. But, man, this is the supply-side data that the industry craves. Like brokers crave this information.
Yes.
To be able to answer, how's the market doing? Like, this is the answer.
Right. Right.
And it just continues to go on and on and on.
I'm seeing
and then it gives an outlook, which I won't read, but it's all there.
I'm seeing a new category on the Calm app.
Oh, yeah?
Yeah. Instead of, like, Nick Offerman reading, bedtime stories. You got you reading the market narratives.
I can put you right to sleep, baby.
Oh man, it'd be so relaxing, and your voice is just. You've got an incredible voice for radio.
Well, thanks for not saying I have a face for radio. That's very nice.
You're welcome. No, you got a face for the camera, Bo.
So after that narrative, this is where the Boulder report started. Okay.
Right.
It started with this page. Effective rent, 14.76%. We read that in the narrative. Vacancy rate, 22.6%. Income growth, job growth. We see that. You have these same tables, and it just takes you through. And what we can see here is, absorption rates. The same thing we saw in the others, except notice this time they have CBD data in comparison to Louisville, in comparison to the United States. So in 2024, change, right? And here we're talking about asking rent per square feet. They're expecting in 2024 asking rent per square feet to go up 0.5%, so not much. S1 and S2, this is really interesting what Moody does here. These are the downside scenarios, okay? So it's saying we expect 0.5%, all right? But downside scenario 1, this corresponds to and is consistent with Moody Analytics' downside 90th percentile, okay? So it could go down 0.8%. Worst case scenario, it goes down negative 1.1%. But
that's not what they're projecting.
Yep.
It's just like
they think 0.5%. But if things go bad, 0.8%. If things go really bad, negative 0.11%.
Oh, that's...
So it gives you guardrails to think through.
Sure.
Right.
And, well, I wonder, the projection, is it always an optimistic projection?
No, they could all be negative.
They could all be,
Or they could all be positive.
Sure.
Just different levels of positivity.
The worst case positive scenario. Mm-hmm. Yeah, okay.
Same thing with vacancy. They'll give you the projections. And so if I'm talking to a client who wants to lease space in Louisville or somebody who wants to buy office space in downtown Louisville, which I don't know if there's many of those these days, I'm going to say, look, we're projected to have 22.6% vacancy in 2025. All right, but if things go bad, it could be as bad as 25.8%. All right, so like there's a potential range there. We're projecting the future. We can't control these things, and we can't necessarily anticipate all the scenarios. But if things go bad, it could be as bad as maybe almost 26% vacancy.
Wow.
So a quarter of the space being vacant, et cetera. And then as you scroll through here, it's just all kinds of supply-side data, absorption trends, new construction trends, performance with asking rent, percent vacant in inventory, rent distributions. This is just great data when you're analyzing a market. Mm-hmm. And if I wanted to, we could grab the report for Louisville as a whole. So these are the REIS reports, and it's one of the best sources of supply side data in the market, in my opinion. Moody's, frankly, by buying the REIS report, for buying REIS and packaging it in with their core products, has made REIS reports actually affordable. Like, these were very expensive to get, and you'd have to either subscribe to REIS, which was expensive, or I think you could even like order one report for one specific market and property type, and those were very expensive. But now, for any market that Moody's covers, I can go get these REIS reports.
That's great.
Anywhere in the United States.
Yeah.
And so as our fund looks to invest in different markets, like, I'm using these every time I'm analyzing a market.
Yes.
And we'll use these in our next episode when we do a market analysis of Florida market.
What do you do in a market where this isn't covering your market?
I need to go count how many office buildings there are. I need to figure out how many square feet's in each one of those office buildings. Now, I can look that stuff up online.
Yeah,
right?
Just like in different places or...
Yep. I need to figure out who owns that stuff. Now, if I build relationships with these folks and I continue to talk to them and provide them with valuable information as well, over time, I can get them to share with me, you know, what are their tenants paying in rent? I can start to collect this information.
Yeah.
And once I have a big enough data set, then I can start to speak with authority on Owensboro has X amount of office space, this much of it's vacant. For a vacancy percent of this, we have this kind of absorption. And if you go back to our market analysis or the market report episode, where I created the market report and I kind of went through office, retail, industrial, just as an example of how you do a market report, that's the kind of information that I was sharing. I was talking about absorption and vacancy and asking rents and that kind of thing. That's because we can go collect that.
Yeah.
All right. And there's some other sources that provide this type of data, like CoStar provides it. Now, I find CoStar in the smaller markets to be not quite as accurate, and it's so expensive. Now, I want to show you one other thing. You remember when we did the absorption episode? Yeah. Like, absorption is an interesting number, but you can't really use absorption and make decisions with it unless you know something else. Do you know what that is? Do you remember?
It's not coming to me.
It was the long-term average occupancy.
That's right.
For the market.
Okay, yeah.
And every market has a natural amount of vacancy that it needs for it to operate well. So in great markets, you know, when things are good, there's going to be a certain amount of natural vacancy. When things are bad, there's much more vacancy. Sure. Much more than the market needs to operate efficiently. So as you look back, you can start to decide, okay, what is the right amount of vacancy? And the natural vacancy point, now if you go back, we're going back to all these other episodes where we sort of laid a baseline for this conversation, which is kind of cool. Yeah. When we did the market and the market cycles episodes, there was two episodes we did on market cycles. There's a point in the market cycle called equilibrium. It's at the top. It's where supply equals demand, right? Rent growth is going up to that point, and then the rent growth percentage starts going down after that point of equilibrium. Your vacancy number at equilibrium is that natural amount of vacancy that your market needs. Yeah, okay. When you know that amount of vacancy that the market just needs to operate efficiently, and you know the absorption rate, then you can start to forecast when do we need to start adding new supply to the market. Right. Okay. Yep. That's a hard number to figure out. All right. But if you go to Data Hub here. Data Hub. Now we're going to just continue to use office here. All right. And let's choose a big market. Like, let's just use let's use Austin, Texas. Robbie Eves called me this morning. I got to call him back. He's my good buddy in Austin, as Robbie. Is Chris. Oh, yeah. You know, the shout out. So we use office, and let's do we want to use submarkets? Let's just use the whole market. And let's select all the data sets, click settings. I don't want monthly and quarterly data. I just want yearly data. Okay. Now let's download it. And it's just going to give us years. So here's what you can do. You got all these years going back to 1979. So we're looking back 40 plus years, 45 years, we're looking back. That's great. That's a great data set, 45 years. And here's what we have. Inventory. I'll make this a little bigger. You have inventory completions, so that's new inventory that year. The vacancy percent for that year, right? Vacancy percent changes by basis points, right? So this is 4% change, 11.8% change. Vacant stock, so how many square feet is vacant occupied stock? Net absorption, asking rent change. Now, asking rent change, this is a big column right here, because what I described earlier, when asking rent percentage, and that's what this is, asking rent percent change. When asking rent percent change is positive, it'll go up positive, positive, positive. And when it turns negative, that's when you clip that equilibrium point, right? And so if we look down here and we see, all right, this was positive, and then it went negative, we had equilibrium in there somewhere. So I want to highlight this column. Let's do this one in yellow, all right? And let's do the negative one in red, okay?
Okay.
And then we want to go negative, 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 negative. Oop, we had negative to positive. So here we had another equilibrium. That kind of went to the trough. It was going down, 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 and then it hit the trough. So here we're going to go red. Oop, nope, nope, nope. I want the whole column. Going red, and then we go to positive. This is starting to go up. So we have positive, 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 all the way to 2001. We went negative or positive to negative. So we tripped that again. And I know this is getting a little tedious, but just hang with me.
No, I got you.
Negative, negative, negative. Oop, here we went negative to positive. So here's a trough for us, bottom of the market. And then positive, 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 positive. In 2009, we went negative. That was, so we went positive to negative. This was a peak. Negative, negative. Oop. Real quick, we went back from negative to positive. So that was a quick trough there. And then we've been positive, and they are forecasting now worst case scenario, scenario 1 and scenario 2. All right. If things go bad, we could actually go negative again. If they go really bad, even further negative. And these are projections. Okay. Now, what I want to do is we've identified our peaks and the valleys based on the data.
Sure.
And I want to know what was the vacancy at those points.
Okay.
All right. So let's scroll back over here to vacancy percentage. Now let's look from the peak to the valley. All right. We have kind of this 14 to 20% vacancy. So we had a big bump. We also had a lot of completions here. We had 4 million square feet of new inventory added there. Okay. To me, that explains a lot of that big bump. When you add that much to the denominator, you know, when that space is delivered to the market, it's delivered vacant and it has to lease up. All right. So that 14 to 20%, that's a big jump in vacancy, but the completions explain that. So I'm not real concerned about it, but we've got a data point at a peak somewhere between 14 and 20%. Okay. Then we hit a trough. All right. And it got as bad as 28%. Okay. And then 23% vacancy. So then you fast forward. This was back in 89, 90. Now we're going to come 10 years later to 2000 to 2001. We have another peak. It got really, really tight vacancy. Okay. And then there was another, you know, in the period of 2 calendar years. Actually, look at all this new supply.
Wow.
So it was just growing like crazy. And we have another peak point somewhere between 4 and 16%. Then we have 20 to 16.
This was the Bill Clinton years, weren't they? All that added supply.
Maybe. Yeah. And then 20 to 16, and then 18 to 20%, 20 to 18%. So what we've done is we've kind of given ourselves a range. And if we just look over the last 20 years, we've got a low of 4.8% vacancy. All right, that's kind of an outlier. It was 16, 20, 16, 18, 20, 20, 18. And then I look at the last 10 years here, last 12 years, and it's kind of been this range of, low teens. And then it's been creeping back up, all while rent growth continues to go up. Like if I'm looking at that data set and I'm asking you as the analyst, like, you make the call. Based on this data, what do you think the long-term average occupancy or vacancy should be?
I'd say 17%.
Yeah, and like you could make a case for that number, right?
Mm-hmm.
And the next analyst might say, well, I'd probably say 16%. Or next analyst might say, well, I'd be more comfortable with 18.5%. Well, guess what? You're the analyst. You make the call. You know? But you make it based on this data. You identify the peaks and the troughs by identify when rent growth percentage goes from positive to negative and negative to positive, and you can kind of define your range.
Right.
And the peaks mean more to me than the valleys. But in a market like Austin, what we know about Austin is their population growth has been exploding for a while. You've also got to factor in all of these completions that have been going on, and look at how many completions. I mean, that's millions of square feet of new office every single year.
Right.
Which also plays a role in these vacancy percentages. So I'm thinking, what this tells me, with all the new supply, with all the new population growth, with all those new tech jobs, because Austin's a big tech hub these days,
mm-hmm.
with all of that activity, all of that movement, all of the new companies, all of that stuff, you need a lot of vacancy to handle that amount of transactional velocity efficiently. That tells me Austin probably needs a higher amount of vacancy to handle that transactional velocity efficiently
mm-hmm.
than somewhere that just doesn't have a lot of movement, doesn't
mm-hmm.
have a lot of growth. So I might be more comfortable with saying, man, 20% is a good number for Austin these days.
Right.
Like they need all that vacancy to handle all this velocity.
Right.
And so as the analyst with, a data set and 5 minutes of consideration, which is basically what we just sent here, like I might say 19, 20%.
Yeah.
If I spend another 30 minutes thinking through this and really considering the data, and maybe I come up with a different number. But real quick, I'd probably say Austin needs about 19 to 20% vacancy.
Yeah.
In Louisville, Kentucky, like 20%, that's a high number. Like Louisville doesn't have that kind of velocity, so it doesn't need all that.
Right.
And so they have more vacancy than they naturally need right now.
Nashville will probably look closer to, or be a little bit similar to Austin, because that's a ton of velocity too, right?
Yeah, and I was just there a couple weeks ago, and cranes everywhere.
Yeah.
They can't build hotels fast enough, office space fast enough.
Right.
Residential units fast enough. It's just, because they have all that population growth, which creates more demand for space. So you have to create the supply to meet that demand.
Right.
Yep. And so this is, when I analyze a market from the supply side, especially like Owensboro is different because I live here and I work here and our business is here, and like we'll collect a lot of this data ourselves, and these tools don't exist so much for Owensboro. But when we look at where we might want to invest in other markets, this is the analysis that I'll do to get a feel for the supply side.
Yeah.
And absorption, to me, whatever your average absorption is over time, doesn't mean anything in a vacuum. You need to figure out the long-term average occupancy or vacancy in this sense, or in this instance.
Right.
to give the context to make the absorption number make sense and be able to make any kind of good decisions based on it. But
this is how you do it.
This is how you do it.
Man, I've been asking that question since our absorption episode. Where are you getting these numbers? Where'd this data come from?
This is where you get the numbers.
Yeah.
And frankly, I don't know where else you'd get them.
Mm-hmm.
Other than Moody's.
Moody's.
And so to complete my commercial for Moody's here, what you're seeing here is data that's available for the new Moody's Marketplace or Market Pro product. Mm. And through the CCIM Institute, if you're a CCIM member, you can get this for $125 a month for the entire country.
Wow.
Which is unbelievable.
Right.
So worth it.
Yes.
Even if you only use it for your own market,
right.
It's so worth it.
Yes.
And it's about, a fifth. That's about an eighth of the cost of competing other options that you might have. And in my opinion, the data is not as good for the higher, more expensive options.
Yes.
Which I will not name because I don't want to get sued. So anyway,
Sure.
This is kind of how you do it. When you look at the supply side, man, you need great data to do it. Mm-hmm. And tools like this this is the best data I've run across to be able to analyze the supply side of a market.
Yes. Okay, cool.
And we've been talking about multifamily here, and you can do the same thing for retail or multifamily or whatever. Ooh, let me show you one other thing.
Oh, I thought we were talking about office.
This was office. What did I say?
Multifamily.
You can get this data
for multifamily.
Multifamily, retail.
But we've been talking about office.
But we have been talking about office. So let me go back. So if we go back up here to markets, here's the markets that it covers. And these are for multifamily. Here's the submarkets. You got the West, whatever they call these different markets. But you can change this up. So if I just want to look at the country as a whole, this is giving me the KPIs for the whole country for hospitality. Average daily rate is $151 per room. RevPAR, $96 per room. Occupancy, 63.1%. Let's see. We're in the southern Atlantic region. Okay, if we just wanted to go in there, and then let's say we wanted to look at Nashville specifically. They average $175 per room. RevPAR is 114. Their occupancy is 64.8%. So you can just get a real quick overview of, other markets. You can send out emails. Here's our listings.
Oh, you got your listings.
Like all of our listings are on here. So you can search this for listings, lease listings.
Did you put them on here?
Alice did.
Alice did. Well, yeah, okay, yeah.
Lease comparables, sales comparables. You can actually get comp data, which is sometimes really hard to get. So
nice.
There's just a lot of great data here in Moody's Market Pro. And while I should have probably negotiated some sort of revenue sharing with Moody's before I pimped their product here.
Hey, we're not released yet.
Yeah, we don't. We get nothing if you sign up for Marketplace Pro. But I wanted to show you a great source of supply side data, which is some of the hardest data to get in commercial real estate.
Yeah,
so far, this is, in my opinion, the best data that you can get, the best tool to access it, and it's by far the most affordable option.
Wow. Yeah.
And so I'm a huge, huge fan, and especially if you're a CCIM member, a candidate, or a designee, there's no reason you shouldn't have access to this. It just makes you more effective and more dangerous.
Yeah, that's great.
So, yeah. When we do the market analysis next time,
yes,
like we'll be using this for that market. We'll be using Site to Do Business. We'll be using some other tools, and we'll do an economic-based analysis. We'll do a shift share analysis. We'll figure out where they are in the market cycle. We're going to put all of this stuff we've been talking about for a year. We're going to put it all together
in context
and create a market analysis. And then maybe the episode after that, we can package it all in a story map.
Sweet. That's what's to come, y'all.
Yeah.
That's what's to come. Stick around. If you're on YouTube, hit subscribe, ding that little bell so you don't miss it. Leave some comments. letting us know what else you'd like us to cover and what you think about the episode. It helps us out a great deal. Share this with other people that you think this could be beneficial to. If you're on Apple Podcasts, not if you're on it, leave us a review on Apple Podcasts. We will shout you out. We also do shout-outs, pick comments. We just did a recording like yesterday or the day before yesterday. So we don't have too many shout-outs today.
Yep, that's right.
Because we've recorded this so close together. But we did have a winner for our hat. For a top hat of the market analysis, which we will be doing next week in a market in Florida.
And thanks again to our friends at the TreppWire podcast for the awesome t-shirt.
Yes, thank you to TreppWire. We'll put them down in the show notes as well. Check out TreppWire. And we've got a free weekly newsletter. Sign up for that. It comes out every Thursday. What could they expect from that newsletter?
Well, you get an episode of the podcast delivered straight to your inbox. And in addition to that, 5 to 7 curated articles that have to do with leadership, business, and commercial real estate. So it's just some great information. Takes, just a handful of minutes to consume. And
good stuff.
It's good stuff. So you can find that at subscribe.wgbarron.com.
Yes. And in that newsletter, whenever it becomes available, Bo has some webinars he's doing with CCIM called
Currently Commercial.
Currently Commercial. And they're jumping on webinars that are going to be talking about AI and then all current things going on so you're not left behind.
That's right.
Yeah. Do we have a place to go to that yet? No? It'll be in the newsletter. So that's another reason to subscribe to that. And I think that's it. We'll see y'all next Monday.
All right. Love you, brother.
Love you too. No pop quiz today.
No, I don't think so.
I don't think so either. Okay. Yeah. All right. I love you too.
All right.
Bye, Alice. Bye. Bye.